Hi, everyone. I'm Rick Bensignor. Today is Tuesday, May 4th, 2021, and welcome to this week's In the No Trader Show. Well, it's been a while since I've broadcast. I was on break. I actually counted. It's been 10 weeks since I was away and took some time off. So I am really happy to be back. And based upon your emails to me, you are really going to be happy to have me back. So thank you for all those emails about where are you, and we hope that you haven't left the show and that you're going to continue doing it. And the answer is yes, just needed some time off to handle some things, and I am back and back for good. So let's get into this today's show. All right, in our trader education segment, we're going to talk about the preparation that needs to be done before the market opens each day. In our market overview, we'll take a look at the S&P, and I'll give you my thoughts on the S&P, which I don't normally do. I reserve that for clients through our In the No Trader reports that we write and people subscribe to. But given that it's been 10 weeks or so since I've done this, I'll give you a little clue into what I'm thinking in the S&P. We'll also take a look at the U.S. 10-year Treasury, and let's take a look at gold, because gold's had quite a move since we have been away. And then as far as sector analysis, I'm going to do something that I think this is the first time that we're going to really take a look at this, and we'll take a look at cryptos, which in the 10 weeks I'm gone have proven themselves to be, I think since I left, I would guess that Bitcoin has moved probably from 30 to as high as, I don't know, what was it, 65,000 or so. So it's more than doubled in the time I was away. And Ethereum, which is the second biggest crypto, has dramatically moved higher, crossed over 3,000 a day or two ago. And it's a hot mover. And so we'll take a look at those, and we'll talk a little bit about those too in the sense of the derivative markets that exist for these. So that's what today's show is going to look like. So let's start off with going through a couple more slides, which is to remind you, well, importantly, that you can get my real insights into what's going on across the macro markets, and then a very specific ETF to trade each week, as well as updating you on every other open ETF we have until we close out, is to get my weekly tactical trader report that comes out Thursday nights generally. And again, that is available by subscription through the In the No Trader.com website, as well as my 7-Eleven monthly spider sector ETF report. And if you haven't found out about this, this is something I started last August. It is a report that comes out monthly on the last day of each month. It reviews the returns of the 11 spider sector ETFs. And those, in other words, those are the macro sectors. So energy, financials, consumer discretionary, etc. It goes through the 11 ETFs that cover those and how the spider returned that month. But more importantly, is set to be a portfolio that is looking to beat the S&P's return. So we are in no more than 7 of the 11 spider ETFs. And as of April 30th, the close, we have outperformed the S&P since last August 1st by 3.3%, which is a home run for anybody who knows who manages money. If you can beat the S&P by more than a couple of basis points, you are generally a hero on Wall Street. Almost everybody underperforms the S&P each year. Historically, it is in the neighborhoods of 6 out of every 7 portfolio managers underperform. So we are, again, ahead by 3.3% by simply trading no more than 7 of the 11 spider ETFs. So that's available by subscription too. And anybody who is a portfolio manager or a financial advisor This is a very low-cost way of being able to get your clients into a fund or a theoretical fund. I tell you what to do. You run the fund yourself, but I tell you exactly what proportions of each of up to 7, anywhere from 5 to 7 of the 11 macro ETFs to be in, and how much to be in. So again, that comes out at the end of the month, and you can find out more information also on the In the Know Trader website. And of course, to write me an email, it's rick@intheknowtrader.com. The only other thing we're going to do before we get into the trader education portion is just take a look at how the market's doing this year, how those 11 sectors are doing. So on the far left here, you can see we grabbed this from the very good charts provided to us by StockCharts.com. These are called performance charts. And here I've simply asked for the 11 spider sectors versus the spider itself, the S&P 500. So you can see the S&P 500 spider is up 12.2% on the year. This is as of April 30th. You've got a few outperformers. In fact, if you count, you look here, communication services, industrials, materials, energy, and financials and real estate are the outperformers. So you've got 1, 2, 3, 4, 5, 6 out of the 11 have outperformed. That is fairly standard to get, half or close to half of each, which means you've got 5 underperformers. But let's take a look at what some of the surprises are this year. I'd say first off, if you look towards the right-hand side in orange, healthcare is up 8.55%, continues to trail the S&P. It did so last year, and it is doing so this year. And yet this is a sector that so many people feel was the right place to be because healthcare going into the future, there's so much talk about why healthcare is the future of the country and the aging population and the amount of people who are in their 50s and 60s who are going to turn into their 70s and 80s over the next 10 to 20 years, et cetera, or 20 or 30 years. And but here it is, healthcare continues to underperform. And then if you look at the other surprise underperformer is technology. It is trailing the S&P by almost 500 basis points and continues to be a problem, and even more so after today's decline. So if you look at the QQQs, they have a much weaker chart than the S&P, and they have broken down more today. The market's off quite a bit. Last I looked, the S&P was down about 50 or so as we started the show. And you've got a very nice, healthy win for financials this year, up 24%, so doubling the return of the S&P. And then, of course, what's ahead of everything is energy, up almost 3 times what the S&P is up. And, of course, this is a sector that has been a horrific sector for the bulk of the last 10 or 11 years. It's only had a few years it outperformed, but the longer-term chart is that it's been a terrible underperformer. And in fact, it's somewhere near it is, or near it was back in relative terms to where it was back in 2000. So it's really if you've been in energy, you have not made any money in 20 years. So it has been the absolute dog to be in. But this year, value players really went after the energy names, especially if you think about oil has moved up from 40 to the mid 60s. And that has really given a significant tailwind to the energy sector. And that's why you're seeing the returns like they are. Otherwise, you've got staples as the worst performer. No surprise in the bull market. Utilities down. One of the surprises is real estate, even with treasuries having moved up. Real estate has moved up also, and that is something that you wouldn't typically expect, but that is what we're seeing this year. So a few surprises across the spaces, and I guess the biggest ones are probably tech and real estate. Okay, let's get to our show and here the prep needed to do before the bell each day. And I think this, has to do with what type trader you are. And if you're a very short-term trader, not necessarily a day trader, but possibly down to a couple days, or if you're more of a swing trader. But there are certain things that regardless you need to do each day. One is to know the headlines of the day, the business headlines that count. And there's a variety of ways that you can get that for free on the web, so that when you wake up in the morning, you know what's happened overnight. You certainly can go to wallstreetjournal.com. And if I'm not mistaken, you can get their headlines, which, on the newspaper was always on the far left side of the front page. It would span the entire newspaper, but only probably about 1.5 inches wide. But this gave you the top stories of the day. And I'm pretty sure if you go to wallstreetjournal.com, you can still see that and get all the major news. You just can't get deep into the news unless you're a subscriber. So you can't click on a story, but you can see all the key headlines. You certainly can go to Yahoo Finance, Bloomberg. Any of these type major news sources are going to have for you the major stories of the day. So that's the first thing I'd say you want to do when you wake up. You want to know what futures are doing overnight. So are S&P futures up or down? That's going to have a big influence on the names that you're looking at. So you need to kind of have a sense of what the market is doing as a whole. And besides looking at the major US indices of S&P and NASDAQ and Russell, it's probably a good idea to also take a look at what's happened overnight in the Asian markets, because they often trigger which way we go, or at least which way we open. So if Asia got crushed overnight, chances are US is going to be trading down too. So you want to kind of have a sense of that. And you also want to have a sense of what the other macro markets are doing. So when I say the other macro markets, I'm talking about so besides the stock indexes, you should know what's going on in the bond market, because bonds have a heavy influence on how stocks trade. And you want to have a sense of what's going on with the US dollar. And that has also a significant influence on stocks, both in the macro big term and the ways that that market trades, but also near term. If you're trading anything that's dollar sensitive, you need to know what the dollar is doing. So you want to take a look at that. And then I'd probably, I finish up by looking at, let's say, what the gold market is doing. And I always have an interest in gold. A, I trade it frequently, and B, it also gives you a sense, not day in, day out, but kind of risk on, risk off. And gold's not up all that much today. In fact, last I looked, gold started getting hit right around 11 o'clock in the morning too. I saw it coming off. And with stocks coming off, you would think it might have had a good day, but the dollar is up today, and that's probably what's influencing gold, as well as, if today is kind of a risk off day, then they can even take it out of the metals, regardless of what else is going on. So that's that's kind of step two. So step one was reading the headlines. Step two is know what futures are doing. Step three, I would tell you, is have a plan for if you're playing a headline stock for that day. So in other words, are you playing something that reported earnings the night before, or something that's in the headline of the day that got an upgrade or a downgrade? So you need to know what's going on. If you're going to play a headline stock, then you need to know everything about that. And your homework before the market opens is to read up as much of anything that's going on if you're going to play a headline stock, because the headline stock may or may not move with the rest of the market. It depends what's going on with it. If it was a big beat and it's trading higher in the aftermarket from the day before, even if the S&P is down 10 handles that morning, your stock may be up. And so you need to know what's going on. And of course, you need to know technical levels. And we'll get to that in a second. And also, if you're not playing a headline stock, are you playing something purely technically that you've done your homework on? And you're looking at certain levels. And related to that is, so let's say you're looking for a pure technical play, and it's not a headline stock. It's just, something that's moving along with the market, and along with what its subsector is doing. But if it's that, then have you done your homework on the levels that you need to be looking for? And I'll tell you, it's important to do that homework before the market opens. If it's the former and it's a headline stock, you have to do your homework before the market opens about your technical levels. So you need to have those written down. You need to know them. You don't want to start looking at them once the market's opened, because you're going to be and should be more involved in the price and what's going on. So, and setting yourself up for the levels that you want to play that stock on, either, buying the up move or fading the up move, or vice versa. But you need to know that beforehand. And the only way you can do that is to know your levels beforehand. So when I talk about knowing your levels, I mean something like this. In my institutional report every week, one of the things I do, so look at this box. And this is I pulled this from I don't know, in April, mid-April report I've done. This I give to my institutional clients every Sunday. It's the major levels that are both from daily and weekly charts for the S&P. And I'm told that this is one of the most important things I put into each weekly piece, so that my clients know beforehand as they start the week and can reference this throughout the week, the key levels that the market may play against. And you need to have these. So this is for the S&P, but this is the same thing you should do for any individual stock. You need to know the key levels to play off of, so that when the market's opened, you're not scrambling to figure out where they are. You want to know beforehand what are the key levels to play with. And what this does is it combines daily and weekly charts together, the key levels, into one reference point. So I don't have to go back and forth and start measuring, and where is this trend line, where's this Fibonacci number, and et cetera, et cetera. They're all prepared before the market opens. And I could update this daily if I put out a daily report. And that's what you should be doing. For any stock or any market you're going to play, you should have, before everything starts, this type of information in front of you. You will be you will be able to focus much more on what's going on in the market when you already know and can reference the levels that you need to play against. So that's this week's segment on the prep work you need to do before the opening bell each day. All right, let's get to taking a look at what's going on in the markets. So we're going to start off here. We'll look at three markets today: S&P, the 10-year, and gold. Here's the S&P cash index. Key levels, first of all, 13 sequential upside exhaustion signal of the last few days on the day that made the all-time high. Last time we had one of those, it was also the all-time high, and we sold off for over a week before recouping. And when we sold off, we stopped at the bearish propulsion exhaustion momentum level, which means if you properly got through this level, you'd look for a move down here. It did not. It broke it on an open and intraday, but closed above. It never broke it. So that level, again, held the market. We've got our first key level here at 41.24. Today's low, 41.31 right now. If we don't touch it today and we hold here, then if we touch it tomorrow, it's disqualified because today was down close. And if we break it, it won't matter. In other words, when I say it won't matter, it means we won't get a signal. Nonetheless, we know we're into potential exhaustion and that this is the first key level to look at. If it properly breaks here, it says it's going down here at 40.29. If it properly breaks that, it would say that we're going all the way down to 38.40, which is a little hard to see, but it's here at the bottom of the cloud. And because now the cloud model has nothing to do with the propulsion model. So the fact that they're both exactly in the same place for the next few days is critical. Now that's a heck of a long way down. So that's kind of market crash territory if we were to get there. But nonetheless, if we are, we'd know how important support is there. It's unlikely that that's going to happen, but I know the levels to look at. In red is the 50-day moving average. Caught the low in here, caught the low in here. You had 1 day underneath it. So the last 3 lows have bounced on the 50-day. So that, very interestingly, is going to be very close to this 40.29 level in a day or two. So we know that's an important test area for the market too. But after all this time of going sideways, with earnings reports coming out with well over 85% of all S&P 500 companies that reported beating estimates, the market really still couldn't advance. That's important information too, especially given the fact that we get an upside exhaustion signal. So we are we are particularly cautious and not ready to be buyers, again, to put capital to use. Nothing would make me happier than to get down into lower levels here to be able to buy the market again. But right now, we are not buying. Next, the 10-year. TNX daily. So let's look at kind of the broader picture, and then we can zoom in on this. So this was last spring and summer. The bottoms were made in here, down near, 45 basis points or something like that. Finally, it made its way up. February was the big up move into March. This is where the S&P went from 1% to its highs at 1.75 or so. And now we are, let's take a look at, as we zoom in, what's going on. Well, first off, 1 day before the highest high, sequential 13, standard and aggressive. So we know upside exhaustion. And that was, if I'm not mistaken, only the second time. Let's see. Yep, only the second 13 signal on the way up. The other one caught the high in November for a sell-off that took a month. Actually, nope, it took until January to shoot through. So that was a very good upside exhaustion signal. Lasted 2 months or a month and a half. So here we are again, upside exhaustion signal. I put this line in just before we did this podcast. And I noticed that if you kind of see a little rounding top here, and then this, you potentially have a shoulder and a head, and a couple of little heads here. So I'd be looking at this line too as some type of potential near-term top if we break through it. We have all these down candles. So let's see, that's a down candle, but an up close. And so that lets this be qualified if it broke through, but no, actually it didn't close beneath. Then we closed beneath, but we followed down closes. So none of this is qualified, and we already hit the target this morning and yesterday. So nothing more to take from this other than we're seeing some rounding tops again. And we'll see if this breaks further, then I would expect rates to fall more. Right now, I wouldn't do anything, but I'm certainly conscious of the fact that the 13 was on the high. Next, gold. We'll look at GLD. I normally look at gold futures, but I know you guys are more likely trading GLD. So what's important here? Well, we continue the downtrend from last August. Gold got a major bounce from this propulsion. Oh, no, actually from this TD/ST level. So a double bottom that's moved up. Broke through the cloud for a day, but we've come back down today. 13, potential upside exhaustion here. There's a 13 in here too, so aggressive sequential, caught it in here before we sold off for a week. Now we're getting standard sequential, giving us upside exhaustion signals. We would have to get through 171.20 in GLD to nullify the upside exhaustion signal. So now, questionable how much more room we have after here, as well as the fact that the dollar has been rallying. And I actually think it probably goes more. So that could certainly put a damper on gold. So that's your look at those three metals, which leaves us the last couple of minutes to take a look at Bitcoin and Ethereum. Now, what I just found out a day or two ago, to my surprise, is certainly Bitcoin futures have been around since December of, I think it's 2018 already, when, in fact, when they started trading, here we can look, it's when Bitcoin made its high. Here we go. So if we go all the way back in time, I think it was near maybe 18,000 or something. So let's look at December of 19. Here it is. Let's just go back. Okay, so so as soon as Bitcoin futures started trading, it made the high, and that's when Bitcoin had made its first high near 20,000 before it fell all the way back down to 3,500. These lows in here, back in December of 19. You had that whole bear market for a year, and then of course you've been in a bull market. That then corrected all the way back down to almost 4,000, and then the huge move since. So let's just take a look. So when futures started trading, it first topped. And the reason, I'll talk about that in a second, is what I just learned, as I said a day or two ago, is that Ethereum has futures traded on the CME, the Chicago Mercantile Exchange. I did not know that. When they started trading them, Ethereum was only trading at, I think, a couple $100. So one futures contract they made is 50 Ethereum. Now with it trading over 30,000, 50 Ethereum gets you a contract worth 150,000. And they may start. So part of my new knowledge is that you can now trade, obviously trading Bitcoin futures is only for the extremely wealthy, because one futures contract for Bitcoin is 5 Bitcoin. So it's 5 times $54,000. So you need to put up a boatload of margin money, and Bitcoin makes you put up more margin than any other futures contract because of the volatility. So this has priced out, Bitcoin has priced out all small speculators from trading because it's 5 Bitcoin. And what I just found out too, as part of this just found out story, is that Bitcoin now has micro futures for and it's just 1 Bitcoin. So it's now just one single Bitcoin at 54,000. So that is much more doable for lots more people. And there's talk that they're going to do the same for the Ethereum Bitcoin, go into micro futures. Nonetheless, here's the high in Bitcoin a day before. Is a combo, the sister model, or 2 days before the combo model gets a signal. And if I look at the weekly, here's what the weekly looks like. So you had a 13 and 9 going into the highs. So I am cautious about it. Here's the daily chart that we were just looking at. And you've got, for those of you who know candle patterns, you've got an evening star pattern of the last couple of days. Stopped at today's low so far, but is the conversion line. But I kind of think that this can come back down and spend more time here in the cloud. So I'm not a buyer of Bitcoin here. And if we take a look at Ethereum very quickly, because we're out of time, this has been really moving strongly. This is a daily chart, really moving strongly higher. And today being May 4th, you can see there's a 9 count in. So it's the first one since they started trading. So same thing too, you may very well get a corrective candle down tomorrow. You at least have 3 pieces of a morning star. So I'm not chasing after Ethereum, would like to get it much more down if it corrects, into this area in here. But this has been flying recently. That is it for this week. Hope you enjoyed the show. And as I said, I am back, and I'll be back next week. This is Rick Bensignor for In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.